My name is Rocky Tong, and I'm the Director and Head of Policy Research of the FSDC. Today, we are making an announcement of our report entitled Observations on Market Liquidity Enhancement, and we are pleased to have 4 distinguished speakers with us. To my left is Dr. King Ao. He is our Executive Director who manages the operation of the FSDC. Then we have Ms. Ding Chen, who is the CEO of CSOP Asset Management. She's also a board member of the FSDC and also the convener of our Mainland Opportunities Committee. Next to her is Mr. Thomas Fang. He's the Managing Director, Head of China Global Markets, QFII representative of UBS. Also, he is a member of our Mainland Opportunities Committee. Last but not the least, to the very left is Mr. Jonathan Finney. He is the Managing Director with the Citadel Securities, and he deals with the APAC business development. So together with these 4 distinguished speakers, we are going to talk a little bit about why we are looking into this specific topic. Well, Hong Kong has been a very successful world-leading IPO center, having ranked first in IPO funds raised globally in 7 out. Trading has shown some room for improvement. Well, with a higher degree of liquidity, we can see more efficient price discovery process, and therefore we will be able to see a better valuation of our stock market. And therefore, I'm sure that the distinguished panel will be talking about why we are doing this. In this paper, we are proposing a couple of recommendations for the government and the exchange to consider. They will cover the operational side of things and also the inspirational side of things. So without further ado, I'll pass the floor to Ms. Ding Chen, and she will walk us through the key areas of our paper. After that, we have prepared a few questions for the panel to answer. Following that, we will have a Q&A session where the panelists will be trying to answer your questions that are typed into the Q&A box. So, Ding Zhong, over to you, please.
Thank you, Rocky, and good afternoon, everyone. And thanks for joining the press release for this report. And this report is prepared by FSDC and Mainland Opportunity Committee. Just like Rocky just said, Hong Kong has been an IPO fundraising champion for many, many years. And despite the success of IPO center, secondary market activities in Hong Kong definitely has rooms to improve. Especially compared with the other leading global financial centers. And secondary market trading liquidity is very important. It's an important indicator to show in the level of development and the sophistication of the market. And a lot of research shows like stocks with higher liquidity tends to trade in a premium, in other words, trading a higher price. And trading liquidity is not only important to secondary market investors, but also is crucial to appeal the potential issuers like the IPO center, right? We are the champion of IPO fundraising. So for many of the company's valuation is a key indicator for the company to choose a venue to list or to trade. So with all of this in mind, FSDC, we initiated a study to prepare this paper with the aim of identifying potential mechanism enforcement enhancement that can boost our secondary market trading volume in Hong Kong. I will go through this report. This report contains 2 major parts. First is where we are, the background, and as you say on the screen, so the global market liquidity. On the left-hand side, you can see the chart. For the past 10 years, Hong Kong's security market trading volume goes up quite a lot. We improved quite a lot, which is good. And on the right-hand side, we can see another chart. It shows the value of equity share trading between among different markets. So if we use special terms called velocity, it's the value trade relevant to the relative to overall capitalization. We can see, in the past 3 years, U.S. market, you can see, is around 100% roughly. And mainland China, obviously, is most traded market in the world. It's around 200. The highest one is 270%. And Japan, is also a very tradable market. It's 100% as well. Surprisingly, Korean exchange is also provides quite a lot of good liquidity in the market. It's also around 200 something. And Hong Kong, our velocity is about 76%, which is not the worst. Compared with Singapore, we're much better than them. But compared with major exchanges, we have rooms to grow. And if we go to another page, we can see, why is that? On the left-hand side, we see a chart, a pie chart. You can see, the right one is 2020 U.S. market turnover by investors type. Right, the right-hand side is Hong Kong's market. No, go back, yeah. So you can see from the pie chart, we can see directly to see, the U.S. market is far more away, sophisticated than us. And if you can see market maker side, in the U.S. market makers, quantitative funds and hedge funds, combine these three together, is around 2/3 of the turnover is contributed by this category. Generally, we call them market makers. And on the other hand, if you look at Hong Kong chart, you will see, the exchange participants is normally, fixed on for the market makers. They are only 28.1%. Less than 1/3 is contributed by this category. So if US, the success of US can tell us a story or can tell us a lesson, is Hong Kong, we need to focus on market making. How to encourage the market maker to bring more liquidity to here. And also on the right-hand side, there's a very interesting chart as well. It's talking about the ETF trading. So you can see the ETF trading in the United States. We can see the yellow line shows us on average daily turnover, the ETF shares of the total US stock market trading is around 25 to 30% is trade the ETF by ETF. And on the, on the downside a little bit about this PPT, we can see the situation in Hong Kong. So Hong Kong is only one, single-digit percentage of ETF trading, percentage of overall Hong Kong market. So why ETF matters? Actually, ETF is a very important instrument in the market. First of all, ETF itself provide, liquidity. They have the secondary market trading by themselves. And also ETF, in order to facilitate ETF trading, there's market makers. Market makers, in order to facilitate ETF, they have to borrow or sell, they have to buy or sell the underlying instrument equities. And also in order to hedging or arbitraging, they have to trade other derivatives like futures and options. So ETF obviously, is a very, very important thing we can monitoring, and also ETF can bring more liquidity and make the whole ecosystem more healthy. So we can see from that part, we can see as well, we can see, let's go back a little bit. Yeah, go back. Yeah. So from there, we can see, Hong Kong, if we try to, make Hong Kong market more tradable market. So we also need to, focus on ETF. How can we make ETF more tradable and bring more liquidity to the market? And also that goes to our, recommendations about, the potential measures to enhance the market liquidities. There's a couple of recommendations. First of all, is the enhancement of ETF trading activities. Like we try to give the exchange and the other regulators to encourage them to introduce a new spread table for tick size and more suitable for Hong Kong listed stocks. And also we try to convince the exchange to increase the maximum of spread range requirement to above like 24 spreads. I will not go to details. And the next page. And also we try to encourage the exchange, also especially the clearinghouse seekers to enhance their process. To make sure the clearing are more robust. Yeah, next one. And also we hope like the stock exchange can upgrade in their infrastructure and their systems. Yeah, that's all for our recommendations. And last but not least, so I want to borrow these opportunities to thanks to the people to help us to do the paper, and because this is a very technical issue, and we rely on a lot of our market experts to do that, and they are Alternative Investment Management Association, Citadel Securities, CSOP Asset Management Limits, Euroclear Bank Hong Kong branch, Flow Trader Hong Kong, Optiver Trading Hong Kong, and UBS. Thanks for everyone. Yeah, I'll stop here.
Thank you very much, Ding Zhong, for the very high-level walkthrough of our key research area, as well as the recommendations we put forward for stakeholders to consider. Now we move on to the panel discussion, where I'll just ask panelists a few questions prepared for them. But if you have any very specific questions you may have for us as a panel, do put them in the Q&A box, and I'll try to address them to the right panelists accordingly afterwards, right? So, King, first question is to you. Hong Kong is undisputedly a successful world-leading IPO center, and it has attracted many large and small companies to be listed here. As our executive director and also a former asset manager, why does the FSDC consider it an important topic to look at market liquidity right now? And what is the relationship that you see between market liquidity and its function as an IPO center?
Thank you, Bob. First of all, I'd like to for thanking working group members for their very valuable contribution to this technical paper. So going back to your question, I think we have to ask ourselves, what's the role of Hong Kong? I think we've been serving a very successful role in being an international financial center for China. And now I think, making a very important transition to becoming China's international financial center. What it means is that we want to attract listing of companies from all over the world, especially those that have very substantial China exposure. And that brings up the topic of liquidity, because I think Ding Zhong has already gone through some very informative slides highlighting the importance of liquidity, especially using the US example. If you look at our region, mainland China and Korea, their turnover velocity is well over 200%, right? So just to recap some of what Ding Zhong has mentioned, I think the term liquidity premium is quite familiar to a lot of the market practitioners here today, because it has been very well documented by academic research and practitioners' studies. So just to highlight some of the importance of trading liquidity, because it does make the market more appealing to all financial market stakeholders. From an investor perspective, a more liquid market will generate generally translate into lower trading costs, higher transaction efficiency, lower price volatility, and most importantly, much improved price discovery. That's very important to investors. From issuers' perspective, a more liquid market will offer obviously lower cost for fundraising and also more accurate share price valuations. Again, going back to some academic studies, poor IPO performance mostly are linked to poor liquidity in the secondary market. So for stock exchanges, that's obvious. Higher liquidity means more volume and a broader market. So all in all, liquidity is not just good for the trading participants, but also the whole ecosystem of the financial market, because we have professional service providers involved, right, in the whole IPO process for trading, post IPO market trading ecosystem, and so on. And that also explains why a lot of regulators, exchanges are focusing so much on techniques and rules to improve and enhance liquidity.
Thank you very much, King. Thomas, King mentioned quite a few times about the listing market and how, the improved liquidity would benefit, people bringing issuers to Hong Kong. And I'm sure, this question is right for you. You are the one bringing a lot of issuers to Hong Kong and allow them to be listed here. So what does liquidity mean for these investors and issuers? And what are currently some of the pain points caused by insufficient liquidity? Are there things that we need to be done in order to boost the trading activities in the secondary market of Hong Kong?
Sure. Thanks, Rocky. And again, thanks, Madam Ding and Dr. King for the opportunities. So UBS as one of the major liquidity providers and also sponsor for the regions, and particularly for Hong Kong. We care a lot in terms of how to protect all the investors, also ensure the region here, Hong Kong, will attract the most vibrant issues and corporates, which is very important. I think among those, so liquidity is extremely critical, and it reflects from investors' point of view the depth and the sophistication of the market. It reflects how investor can achieve their investment goal in a very manageable trading cost type of manner. And also it reflects risk. When we talk about pain point, a lot of times when markets in extremely volatile or difficult or exorbitant situations, liquidity reflects even more from an investor's point of view in terms of how do they achieve their investment objective. For issuer, obviously, as Dr. mentioned, it reflects how easy they can access to the investors at a good or fair valuations to raise money. But at the same time, overall, it reflects how issuer can really grow with the exchange, right? Grow with the investors. And we've seen a lot of successful issuers grow from a very small company to our large institutions through the exchange. So all of those are extremely important. There are a lot of pain factors as the working paper have listed out. And to really zoom in, those issues. So the working group really work with experts and exchange participants, broader investor and issuers, really to distill and identify some of the sort of executable recommendations. Some of them have listed here, introduced by Madam Ding. But overall, we wanted to focus on the overall ecosystems, whether it's ETF or market making, just to ensure in many ways liquidity attracts liquidities. We need to look at the overall exchange rules and the infrastructure, the cost base, and how to, enhance and really ride on Hong Kong connecting, China connecting world to provide us liquidity to the investor and also attract interest.
Thank you. Thanks a lot, Tommy. I love how you put it. Liquidity attracts liquidity. And Jonathan, that really brings to a question that we have prepared for you. It was, first of all, a great pleasure to meet you about a year ago when we started this project, and you provide us with a lot of useful insights. So thank you. This report actually focuses a lot on market making activities and also ETFs. And, as one of the leading market makers in the world, perhaps you can share with us some of the key roles of, you and your peers as market makers, and how you guys are providing liquidity to the market, and what are some favorable conditions that can perhaps, incentivize you to do more, you and your peers to do more here in Hong Kong.
Thank you very much, Rocky, and thank you very much to the Financial Services Development Council for listening to the market participants' views and producing a wonderful paper, and secondly, inviting me here to share more thoughts on these topics. It's incredibly relevant, incredibly current with regards to not just Hong Kong, but the world generally as they look to progress electronic trading. And again, to coin, Mr. Thomas Fang's lovely points, liquidity does beget liquidity, and it is definitely a case where once momentum is built up, success becomes a lot easier to achieve. So to answer some of your questions, I'll break it down and look at how market making and I guess electronic liquidity providing has kind of like gone hand in hand with the progression and evolution of electronic trading. So if you look at COVID generally, the ability for all of us to work from home, the ability for, frankly, exchanges to work from home has shown that electronic trading is capable of overcoming a lot of the hurdles that were previously in place. If I look at the NYSE Stock Exchange and their IPO process as an example of how many IPOs during that period were able to be seamlessly had from a COVID environment where there wasn't anyone in the office. So looking at how liquidity providers generally look at exchange evolution, health and liquidity, it is very much a case of technology. That is a key one that we will look at. Operational regulatory costs and risks to business. And then ultimately, what is the incentives in place to kind of like perform within a given environment? So those are the kind of things that we look at. Hong Kong is a fantastic ecosystem. It has such a wealth of participants. It is a very high quality market environment. And I think that has a lot of things going for it. It does have a relatively high cost of trading. And that is something to kind of like consider, is that how can different participants and the exchange in particular help with those things? So one of the things that we spend a lot of time, and we helped contribute our thoughts to this paper, is around technological and operational hurdles. So this is why we spend time talking about things like self-match prevention or a multi-clearer solution equities, because just removing those hurdles actually allows more strategies, more teams, more just general participants to enter the market, therefore just creating a much more vibrant environment for which the markets can continue to increase liquidity, increase volume, and ultimately help support primary markets. So those are a couple of the ideas that we kind of contributed to the paper. One thing that I would comment on is that Hong Kong Exchange have been very, very receptive, I would say. Like they have very much engaged in a very client-centric model, which is fantastic, whether that is because of the FSDC's intervention or not, but it's been great to see the two partnerships working hand in hand. So bilateral dialogue is at its highest, which is fantastic. So we are very, very positive and optimistic for the future of Hong Kong Stock Exchange.
Thank you. Thanks a lot, John, for the very a positive outlook, so to speak. I'm sure that there will be some people from the stock exchange dialing in because, as always, our friends at the stock exchange are very supportive of many FSDC related initiatives. And so, we look forward to working very closely with them as well. I like how you highlighted, some of the thoughts that you have contributed to the paper, which is really about the long-term development and also measures to reduce the transactional frictional costs, for trading in our market. So hopefully, some of those recommendations, if not all, will be implemented. Ding Zhong, I'm coming back to you. Being the ETF expert on this panel, I'm going to ask you a couple of questions in relation to how Hong Kong's ETF market has been faring and how best we can develop our ecosystem even further with regards to ETF trading and the issuance of ETF on our stock exchange.
Yeah, thanks, Rocky. And obviously Hong Kong is Asian leading ETFs, financial center. Right now, by end of this June, Hong Kong's ETF trading AUM. First of all, it's AUM. AUM is around 440 billion Hong Kong dollar, and the counts are about like 2% of the total cap. Counts about 2% of the Hong Kong total market cap. And the trading volume, ETF turnover rate right now, this year, we improved quite dramatically from last year, like more than 4%. This year improved to 9%. We can see, the market did get some progress here. And also in the paper, we have discovered quite a lot of measures try to how to improve the ETF trading, how to boosting the whole trading environment, and also bring more healthy ecosystem to here. And also I want to re-emphasize one thing is like Jonathan has mentioned, the Hong Kong Stock Exchange is very, very supportive for this paper, and also they are very keen to bring more technology and everything on the table to facilitate the market making and other market aspect. I think that there's one thing definitely Hong Kong Stock Exchange and CCAS can do more to improve the efficiency of the in-kind creation and redemption. So right now the in-kind creation and redemption in Hong Kong is quite manual. And but if you look at the statistics, you will find this sort of market activities very, very valuable to the market liquidity. So for instance, the top 3 Hong Kong ETF, the in-kind creation, in-kind and redemption contributes another 3% of underlying stock turnover in the whole market. So if we can, make this in-kind creation more robust, I believe we can bring more liquidity to the underlying stocks. And right now, as I said, the whole process is quite manual, and also the trading cost is relatively high, and the participants is only open to like market participants in Hong Kong. But if you look at mainland China or US, even retail investors can participate in there. So if we can improve that part, I think it's also a boost for the market. Thanks.
Thanks, Ding Zhong. So what you mentioned include both a domestic and perhaps cross-boundary kind of collaboration. King, as a former asset manager, managing not only ETFs but also other funds, do you have something else to add?
Yes, I want to emphasize that ETFs are also good investment tools for active managers, right? It's not just for passive tracking, because they do provide very cost-effective means for tactical asset allocation, right? If you have short-term movements, it's a lot easier to use ETF than buying and selling a basket of stocks. And also, most importantly, the more the ETF market becomes, the more product innovation you see in the market, such as the launch of thematic ETFs, technology innovation, how computing type ETFs, and ESG, for example, type of indices are gaining momentum in the market. And also, the more liquid ETF markets are, the more liquid index derivatives will be available. And that's important. So we have seen these will provide very useful risk management tools for both conventional and alternative managers. The example I want to cite is the recent launch of the MSCI China A50 Connect Index Derivative Warrants, which were the first batch of listed Asia structured products in Hong Kong. Overall, liquidity for ETF also benefits, I believe, the whole market and all type of investors. So it's not just the passive managers.
Thank you. Thank you very much. The derivative warrant that you mentioned is also one of the recommendations of the FSDC earlier paper too. So you see how we work very closely with our partners. Jonathan, a question for you. King mentioned that, besides the thematic ETFs and a lot of underlying investment vehicles such as derivatives would be possibly benefiting from a more vibrant ETF market. So besides being market makers for ETFs, I'm sure that can be more done here in Hong Kong. What are some other market making programs that Hong Kong can consider?
Sure, that's a great question. I also know that there is a question in here which I can tackle at the same time. Market making programs. So generally, market making programs are quite varied, shall we say, across the globe. We are a large market maker across many asset classes. So we have spent a lot of time speaking with many exchanges, both to advise on current market making schemes, but also to help with newer exchanges develop their own market making schemes. So we actually had an educational session where we spent time with a lot of different exchanges, both in APAC, but also in other parts of the world, looking at this subject. So it is, again, very topical. It really depends on what you're trying to solve for. So there are different problems. I think if you look at the most common or most popular market making program, it's actually within the medium to high liquidity range where you look at volume incentives. So in this particular case, the exchange has said that, okay, yes, we have liquid instruments, but we can always do better. We can always do more. So having a volume incentive just basically reduces that cost of trading, reduces that operational cost, which incentivizes many participants to trade more and more. So this is actually across the whole board, whether it's institutional, whether it's prop or whether it's retail, like there is definitely an incentive to continue to trade more as those costs go down, right? So more idea generation, less hurdles, etc. So at the higher end, volume incentive schemes tend to work. Within the medium band, this is where you start to play around with rebates, for example, where passive liquidity on the touch is important to kind of like help attract new investors into that asset class. So an asset manager may be looking and saying that, okay, there's not enough shares on the bid and offer for me to trade, which is why I then trade the product. So incentivizing passive market makers to participate is one way to attract investors. So by doing that, some markets can participate in make-a-taker arrangements or rebates, but not all places can operate a rebate mechanism. So one popular innovation, I would say, that's occurred in Europe and now is actually coming out to other places that they look at the success of this, is actually rather than operating a rebate model, you have a look at the fact that many market makers are both active and passive, right, in terms of their trading. So reducing the discounts for active trading as well as passive helps offset the obligations that you're looking to put on the market makers, and also avoids the problem of rebates where you have the exchange explicitly paying participants. So that's another way that the industry has helped solve that problem. And now touching on this question that's been raised with regards to illiquid stocks, generally there are several ways and they're very innovative. Sometimes they work, sometimes they don't. It is an iterative process. Some exchanges try a stipend model where you're getting a fixed fee for a set amount of obligations. And then there's a revenue sharing model as well, where you may want to try something incredibly innovative, whether it may be an ESG product or an ETF, etc. You really want to tie the market maker into the long-term success of this product. So entering into an incentive program that ties in that long-term success to obligations is one way of doing that, where you're all in this together. one way that some people have tried to solve for the fact that illiquid programs by themselves don't seem to succeed is just to address the real elephant in the room, which is basically if you have 5 really unattractive illiquid names, you're going to need a pretty decent incentive to get people to support these products. And it's not usually the case that an exchange has those tools to its, in its arsenal, just for those 5 stocks. So sometimes you go, okay, right, if you trade more volume, you get cheaper stocks, but it's illiquid in the first place. Or we'd give you a stipend every month for you to support liquidity in the stocks. That stipend's never usually enough for those 5 names. So what we found in developed markets is they're starting to broaden out their incentive program. So you have 100 names, right? And you have a mix of liquidities, high liquidity, medium liquidity, low liquidity, very low liquidity. And you have to have obligations across the board, and you have incentives across the board. So on average, the market makers can perform those obligations. And on average, they have incentives that incentivize them to match those obligations. So here are different ways you're finding exchanges like trying to suit what is right for their markets. And it's a fascinating topic. No one size fits all.
Fantastic. Thanks a lot. I think you've covered a lot. So from the volume incentive, it's not necessary for the stock exchange to actually lose revenue. In fact, like by the providing such volume incentive, everybody can be benefiting from it, right? Because like you may lose as a percentage, but then at the same time you have a higher volume, then that really benefits the exchange. At the same time, on the rebate model, you will be able to benefit a lot of different participants, not only the market makers, but also the investors who are investing in both liquid and illiquid stock. And lastly, when you talk about the various incentive program for trading illiquid stocks in developed markets, there are many options out there. So, like even when the exchange or relevant participants want to discuss it, I think, like the market will be more than happy to discuss the best practice, like in various markets, right? So, Ding Zhong, one question to you. You were alluding to it already earlier when you talk about both domestic and also cross-boundary type of activities. The ETF Connect was actually launched earlier this year in July. And so do you see or do you feel that the ETF Connect will help boosting Hong Kong ETF market, enhance the liquidity of the Hong Kong trading market?
Yeah. This is a very good question. So the answer is absolutely yes. So for the past 2 months, since the ETF Connect launched, we can see, and also there's good news to Hong Kong markets. Like average daily turnover of southbound flows is about 250 million Hong Kong dollars a day. It's like 10 times larger than the northbound flow. And what that means? That means, the southbound ETF, although we only have 4 ETFs eligible to that, it's far more attractive to mainland China's investors. And among those 4 ETFs, including the southbound trading, CSOP Hang Seng Tech ETF attracts over 60% of the total cash inflow from there. So obviously, mainland China capital market is one of the most liquid market in the world. And through this ETF Connect, we can, inject the mainland China's liquidity to Hong Kong market, which is definitely will benefit not only from the secondary market trading volume, but also the primary market as well, because the trading get boost and the market maker can, because more people buy, pretty much we can to get a little premium, and the market maker can arbitrage that and can create more ETF issuer to the market. So that will definitely enlarge our AUM. So that will benefit both secondary market and also primary market. And for this good sort of connect, we hope like more ETF can participate in this scheme. So compare with mainland China, the northbound, they have 83 ETFs. We hope more and more Hong Kong ETF can participate in that, and also benefit from that. And also, currently there is some hurdle as well. So for the southbound, if you in mainland China try to participate in this ETF Connect scheme, you have to have at least 500K RMB for the past 20 trading days. But from outside, from Hong Kong side, if you try to participate in northbound, there's no such a hurdle at all. And also because of the 500K limit, we find in mainland China, there's only 4% of total investors can meet these requirements. So if the regulators can remove this sort of requirements, we think it will benefit from our ETF. Yeah.
Thank you very much, Ding Zhong. I think that makes a lot of sense. So with a wider scope of ETF, a wider range of ETFs being included in the ETF Connect scheme and the lowering of entrance barrier for investors who are looking to divest or perhaps, manage their risk, not only within the mainland Chinese boundary, then, the ETF Connect can play an even more important role going forward, in the capital markets connectivity.
Yeah, definitely. Rocky, you make a very good point. As ETF is a diversified, portfolios. So there's no way to say, with diversified lower risk, products, still we should apply for the single stock restrictions.
Absolutely. Thank you. Good. Now that we're almost done talking about the ETF market and market making mechanism, I'd like to take a look at the opportunities for Hong Kong. Tommy, as we highlighted at the outset of this paper, we said how Hong Kong has been playing a very important role as the capital formation center for new companies looking for a place to issue, or for IPO activities, right? So you have seen, or we have all seen, an increasing number of Chinese companies listed in the U.S. stock exchange seeking primary, dual, or secondary listings elsewhere, and Hong Kong is one of those, markets to be considered. What are some of these top issuers that you're in touch with, and what are the measures or areas that Hong Kong can do to attract more such issuers to be here?
Sure, Rocky. Yeah, I think that's a extremely important topic, right? If you look at the past 20 years. Almost all of us benefited from this overall trend of financial open for China with a lot of issuers, and with the Friday's announcement, so this homecoming ADR to Hong Kong, along with some of the other measures, the GDR listings, are really driving and shaping the overall financial opening for Chinese companies. In many ways, they're looking for similar characteristics from listing venue, right, in terms of easy access to investor, a robust but also issuer friendly regulatory and infrastructure to comply and then maintain that listing and also liquidity. So all of those would definitely be extremely important. And by talking to the potential and also feedback from the existing issuers, obviously the overall listing regime for Hong Kong and the Hong Kong Exchange are very important. Because be able to cater WVR, startups and all of those, and Hong Kong continue to make improvement from that regards. But I think for today's webinar, if we look at more from an investor or liquidity lens, as I definitely echo Madam Ding's comment. So southbound is a really regime change, right, in terms of Hong Kong Exchange to write down those Connect program, and then really to look at liquidity, look at the sophistication of the investor, really guide onshore investor, whether it's retail or whether it's broadening of institutional investor through southbound or maybe other channels coming into Hong Kong. So that will really bring the vibrance and also the liquidity, therefore attracts issuer. At the same time, as I mentioned, ecosystem have more products, for example, ETFs and more indexing, products, topical ESG, and all of those can really enhance and attracts and then really make the issuer stay and to enjoy the benefit of listing there.
Looks like liquidity, the depth of our market and sophistication of our market participants, among others, are very important to us. And that really reiterates why, we are putting forward this paper for the public sector's consideration. Jonathan, I know you mentioned a little bit of this already, but I have this question for you with regards to technology and electronic trading, which is obviously going through some rapid evolution, but partly perhaps as a result of the COVID. What other opportunities and threats do you see for Hong Kong from the technology and trading perspective from you, as a leading market maker?
Sure. So that's a great question. I guess to answer it very shortly, that there is a significant amount of opportunity for Hong Kong exchange, both on the equities and the derivatives side, and I'm including ETFs within the equity bucket for this. But definitely, there are a few threats. Like generally, as you see, technology that has been highly correlated with a reduction in transaction costs. I think that's been shown across the world. You can see a lot of exchanges really supporting and progressing on the technology. You've got 2 major upgrades next year with Thailand and Korea. You've got Japan the year after. So these are significant upgrades in technology that these exchanges are investing in. So it's a case of, okay, in the equity world, Hong Kong's in a great spot. But as we start to develop the derivative world in greater depth, that is more of a competitive market, actually, especially to King's point earlier, where you have more innovation on the indices side, more innovation on ESG. That's not necessarily locked into any particular market. So I do think you're going to start to see a more competitive environment. I definitely think that technology will be a critical factor in that growth.
Fantastic. Thanks, John. It reminds us that, equities is only part of the entire investment space. And, we definitely should seek competitiveness in other areas as well, from indices, derivatives, to, many other products. So the last prepared question is for King. Well, obviously, we at the FSDC are trying to strengthen our appeal as an international financial center. What are some other upcoming initiatives that we are working on?
Thanks, Rocky, for giving this airtime for promotion. Because actually next week, we'll be publishing a paper on wealth management, titled Cementing Hong Kong Growth as Premier Wealth Management Hub in Asia. Please do sign up for this. We've got some very interesting recommendation. But looking forward, there are several key developments in Hong Kong that also focusing on that capital market opportunities, application of eKYC. Last but not least, I think financial data connectivity is really key to Hong Kong's future as an international financial center. I know we have a lot of questions online, so I'll just pause it.
Thanks. We do have a lot of reports coming up, and so for those of you who are interested in learning more, feel free to reach out to us at the FSDC. We have received a few questions from the floor. If you have other questions, do feel free to shoot it to us via the Q&A box. Okay. So there's a question about why the secondary trading market of Hong Kong is relatively less liquid comparing to the other global financial centers. So we talk about the fact that we are a little bit lacking the other markets. What is the reason behind? I guess John maybe can give us some ideas.
Sure. I like how everyone turns to me for that. So I guess on one hand, I would like to say that actually Hong Kong is a very liquid. It is a great place for participants. as with all areas, all exchanges can improve and should continue to improve to be the future, the marketplace of the future, right? So in the case of Hong Kong, there are several factors with regards to operational hurdles. So we mentioned in the paper there is self-match prevention is one of those mechanisms that just prevents multiple teams within the same company from engaging in one space. So that can actually have a knock-on impact on liquidity. Several of the excellent suggestions in the paper do try and address some of these recommendations with regards to why there is maybe less liquidity. But there's definitely a whole range of technological and operational aspects that can be improved to just generally help. And again, to come back to the point about market making schemes, that has been not as touched upon within the equity space in Hong Kong. And I do think that if to have a successful illiquid program, it is necessary to include the liquid part of it to ensure that that actually is incentivized correctly. Because as someone has already pointed out, it isn't hitting all the metrics of success quite yet.
Thanks. So I will, excuse the second question that we got, which is about how to boost the liquidity of illiquid stocks, because we not only covered that in the presentation, but John, you also mentioned that as well. So there is a question of how can banks be incentivized to market makers or to market making Hong Kong ETFs? Can banks be incentivized to do that? Well, I know Jonathan is not coming from a bank. Perhaps Ding Zhong, do you want to give it a shot? And then for instance, perhaps Tommy can also chip into it.
Sure. So obviously, the market makers, there's quite a lot of different market makers in the market. So the banks obviously fits into the category, and also other security house and the market makers, like I mentioned in the report.
Yes.
Purely market making house, Optiver, flow trading, and so how to incentive them to do more, market maker for the ETF. I think obviously, first of all, the market need to be very attractive.
Mm-hmm.
Like Jonathan mentioned, Hong Kong is a very attractive market to do ETF. A lot of new, initiative or new innovative products is, first or at least first in the region to be introduced in the stock exchange. And the people are willing to try new things. And also for Hong Kong, I think, probably I go back to a little bit about the first questions. Yeah, the online asking is why, the secondary market trading volume in Hong Kong is slightly liquid compared with other global financial centers. So the first of all, Hong Kong, we are quite liquid market, but we are not the most liquid market. Mm-hmm. We compare ourselves with New York, US, obviously the most liquid, market in the world, and mainland China, obviously the second liquid market in the world. We hope we can do things better. And that means we are not good, but we're good. We try to be better. And obviously for incentive to the market maker is the same. I think Hong Kong Stock Exchange and the regulators, they do a lot of things, try to invite more liquidities to here. And like I said before, we allowing to try a lot of new things like ETF. We're doing like leveraging inverse in Hong Kong, which is tremendous success here. And through the ETF Connect, a lot of mainland Chinese institutions, they hope they can have these opportunities through ETF Connect to access to Hong Kong's ETF, like this sort of category. But right now, unfortunately, it's not allowed. The reason is because, financial industry is highly regulated. Mm-hmm. So for every market is the same. So for Hong Kong, we say we are financial center, international financial center, we try to attract investors, but most likely we can only attract institutions from other regions. But retail is for every market, the regulators try their best to protect retails. So although we are, financial center, we are open to everybody, but for most of the regions or most of the countries, they protect their retails. We cannot access easily to attract retail, traffic from there. And luckily, we have a one country, two system. So mainland China, through those Connect scheme and other scheme, we can borrow a lot of retail traffic from over there. And I think if we can do that part better, and obviously we can move Hong Kong market to another level.
Fantastic. Tommy?
No, I think Melanie, covered it quite comprehensively. I think for banks, first we have specialized market maker. They're so specialized and also very much focused on the technology development, which will be the key from our ETF perspective to provide liquidity. But for banks, we have a broader spectrum of clients. So we can go from all the way from wealth management client to the institutional client. It's that ecosystem, whether it's structured products or derivatives or more, marketing. So to make sure our client base are very, very well versed. But overall, it's again, with a good fundamental, with better liquidities. So in general, the clients for bigger banks would definitely be focused on ETFs.
Fantastic. I don't want to pass this question to Jonathan because like I said, he's not from that sector, but I can see that specialization is perhaps something that is to be considered when whether or not one financial institution wishes to enter a different business, as perhaps alluded to by both Ding Zhong and Tommy. All right, so we got a question from Andrew Wells, who is a dear friend. He is asking what can be done to promote the liquidity for SME, not least tech startups. So to him, GEM listing is very expensive and is time consuming. Only one listing in nearly 2 years is the result. So why are we not adopting a NASDAQ type of regime to revive the local economy post-COVID? Well, I know we're working on something. So King, do you want to give it and give Andrew an answer?
Sure. Yeah. Thanks, Andrew, for this excellent question. Yes, it is something we're looking into right now, but on a more broader scale, not just focusing on GEM. That is whether Hong Kong needs an environment to facilitate more liquid or more sophisticated products to trade on different platforms. And also regarding the NASDAQ type regime, we also put forward a recommendation whether we can borrow the pre-revenue biotech listing rules to hard tech. Right, so that hopefully will help some of the startups in Hong Kong and elsewhere. So yeah, we hope we will publish a paper addressing some of these issues soon. But these are very, very important pain points that we need to address. Yeah.
Thank you very much, King. If we don't have, we still have a couple of questions from the audience, but a lot of those questions have been addressed via the presentation or earlier answers to our questions. So instead of repeating them, I would like to encourage you to stay online to answer a poll that we have prepared for you. Please do tell us how we have done and what can be improved in the next webinar, which the nearest will be the one that is happening next week, as King mentioned. So thank you very much for joining us, and thank you very much, panelists, for being with us today. Thank you.